What's up, everybody? Ryan Walmsley, American Pacific Mortgage, here to catch you up on the housing market and the mortgage market for 2023. We're about halfway through the year, and I want to go back to the beginning of 2023 and look forward to the end of 2023 to see what we can expect. So let's dive right into it. So the name of the game for 2023 so far has been inflation. Inflation is important to the housing market and the mortgage market because mortgage rates are dependent upon inflation and what inflation's doing. If inflation is rising, then investors need to raise interest rates to follow so their investments don't get eroded away. So that's why we are seeing higher interest rates right now. And the good news is that we've seen a significant improvement in inflation, and this chart here shows the month-over-month numbers and what they've been doing. We've seen through 2022 this rise in inflation, and then coming through here into 2023 to this point, we're seeing this rollover, and this overall trend is coming down. Now, these numbers are the consumer price index, and basically that is the number that you hear in the news. The headline numbers is what you're hearing, and the CPI is only part of the story. We do know that it's going to continue to come down, and really it's because of the relationship that it has to the producer price index, and that's because CPI follows PPI here, and this orange line is the PPI, or producer price inflation numbers, and the blue line is consumer price inflation. So we can see this relationship here in 2021 as producer inflation was increasing. We started to see consumer prices increase as well. Then we saw this rollover in the producer price inflation, and it's come down hard. It's nosedived. Its trajectory is to go negative, and we're seeing that CPI is following as well. Will it go negative? Probably not, but this is a good indication that the trajectory of consumer price inflation is headed in the right direction. So where are we? For June's number, the headline actually came down significantly from 4% to 3%. Now, this is the all-in consumer price number, but that doesn't necessarily tell the whole story, because if we were at 3% inflation, then why is the Fed still keeping rates high? Why aren't they letting off the gas? Well, it's because of the core portion of consumer price index. The core excludes food and energy, which are really volatile, and the Fed believes that they can control these pieces of the economy better than they could with including food and energy. So we do see that this number has come down from 5.3 to 4.8, but that's still significantly off of where the Fed wants to be at 2%, right? So what's included in core? So what can the Fed actually control? Well, they can influence new car and used car sales, which new cars are still appreciating at 4.1 year over year. Used cars have turned the corner. They're now negative year over year. Earlier in the year, they were still positive, which was really slowing down the core number from improving. But that's we seem to have turned the corner, and we're seeing a more normal relationship with used cars depreciating in value, not appreciating. Motor vehicle insurance is up significantly. That's one of the stickier parts here of the core. But we also see airline fares coming down significantly, down 19% year over year. Now, this is likely due to gasoline prices and oil prices coming down during this period, but still a significant improvement year over year. But these are small pieces of the core compared to the shelter component, which is a whopping 43.5% of this core number. So what's going on with those numbers? Well, we're seeing them improve. Shelter is down from 8% to 7.8% year over year, still very high. And this number has two parts to it, or three parts to it. The rental portion, we're seeing rents are coming down slowly. And this OER, which is 32% of the core, it stands for owner's equivalent rent. And essentially what that is there's a survey done and they call homeowners and ask them how much they think that they could rent their home for without utilities included and no furniture included. So they're asking homeowners who are not experts in the economy what they think rent should be for their home. So it's not the greatest gauge, but it is the one that we have, and it's been the same for a very long time. So people are still thinking that they could rent their home for a significant amount of money. So we haven't seen this number come down as much as we would like to. Now this lodging away from home number is quite volatile. This is like hotels and Airbnbs, etc. We're still seeing this up year over year, but definitely a nice decline month over month. So we know that shelter is the big piece of the puzzle that we have, that the Fed is trying to attack, but they're also looking in the rearview mirror when they're looking at these numbers. So what actual numbers look like in the rental market, we can see here from Apartment List, the actual real-time shelter costs had spiked at the end of 21, beginning of 22, and have come down hard and are right around 3% right now. And these numbers are real-time, but what the Fed looks at as far as calculating CPI is backwards looking. So they're looking in the rearview mirror, trying to predict what the housing market is doing, and it's kind of like a roller coaster. And if you've watched my other videos, you've seen this before, but real-time shelter costs are coming down. But what the Fed is looking at are the CPI numbers. They're still going up, or were going up, and now they're not. So we have this lag that is created in actual numbers versus what's reported in CPI. And what does that look like? So we know that the real-time rents spiked and have come down hard, but the CPI numbers here they don't react as quickly as these real-time numbers. So we've seen this slow increase, and then just recently we started to see the shelter costs in CPI come over that crest, and they're starting to come down. So this will drag out, and we'll eventually get closer and closer to the Fed's targets. And because of that lag effect, we know that a real core CPI should be closer to 2.89% versus 4.8 where it is right now. Headed in the right direction, but still have some way to go. But that's not really what the Fed is looking at. The Fed is looking at PCE, which is personal consumption expenditure. That core it doesn't have as much of a lag effect. So the real shelter component in that reporting is 3.67. So this is part of the reason why rates are still high, is because the Fed is wanting to make sure that the housing market isn't going to go out of control and slow things down. And that's certainly what is happening, and that's why mortgage rates are high. So let's take a look at what mortgage rates have done this year. So starting at the beginning of January, we're right around 6%, and we kind of bounced around between 7 and 6%, and right now we're right around 7% as well. And looking at forward into the future, what can we expect interest rates to be? Inflation's coming down. We know that inflation is, mortgage rates are dependent upon inflation, so we can expect rates to come down as inflation improves, but that's not the only piece of the puzzle that's suggesting that interest rates are going to come down. The relationship between the 30-year fixed mortgage and the 10-year treasury tells us a lot about what we can expect. So a normal market, we see the percentage between the 30-year fixed and the 10-year treasury to be about 1.5 to 2%. So if the 10-year treasury is at 4%, mortgage rates should be at 6%, but that's not what we're seeing. We're seeing rates at 7.2%, and the 10-year Treasury at 4.2%. So we're closer to a 3% spread. So why is that? What's going on? What's creating this this disconnect between what's normal and the market that we're in? Well, it's the anticipation from investors of a refinance market in the future. So basically, if an investor is putting out all this money to originate a loan and to service a loan, but they only service it for a very short amount of time, they could actually lose money by lending that out to a home buyer. So in order for them not to lose money, they're going to charge higher rates than normal, and they might even charge additional costs to lock in that rate to just essentially ensure that they're not going to lose money by lending that money out. So we can expect rates to go low as inflation improves, and as we get closer to these rates reversing lower, we're likely to see this relationship get closer and closer, and that gap get smaller and smaller back to normal 2% range. So there's a lot of encouraging data that's pointing us towards lower mortgage rates. So great, we can expect lower mortgage rates, but isn't the housing market about to crash? I mean, I'm sure your brothers told you that, your neighbor's telling you it's going to crash, the news certainly is telling you it's going to crash, and certainly every influencer on social media is telling you that it's going to crash, right? But are you sure about that? Like, really? It hasn't happened yet, and why? Why hasn't it happened? Well, it's pretty simple. The relationship between the U.S. population and the existing home inventory is why it hasn't happened. So this chart clearly shows the increase in U.S. population and the decrease in existing home inventory. You know, going back to 2007, where we peaked at 4 million homes available on the market, there was only about a little over 300 million people in the United States. Now we're at 335 million, and housing inventory is down to 1,080,000 homes. That's a significant disconnect between the amount of homes that are needed and the amount of homes that are actually available. And this is a byproduct of underbuilding for a decade. You know, from when the financial crisis happened, a lot of builders went out of business and never came back. So we have shortage in builders, and then that's just created a shortage in housing as well. Now let's take a little closer look at then versus now. So in 2007, we had 4 million homes available, and now we're down to this 1,080,000 homes available. You can see that it's been consistently coming down, and that's really what is going to help support home prices moving forward. And let's take a look at what those numbers look like actually, because it's not really what you think. So existing home inventory, what's on the headlines, 1,080,000 homes available. But of that, there are 578,000 under contract that are off the market. So you can't even offer on those if you wanted to. And then that leaves us with 502,000 active listings. Now this is national numbers. It's definitely, you know, every market is different. And let's take a look at the Phoenix housing market. So we can see here that inventories are coming down. From my last video in March, we can see that there was just under 14,000 homes available. I'm sorry, 1,400 homes available. And now there's a little less than 1,100 homes available on the market. In that time, we've seen median list price go from $550 to $650 basically. And that doesn't mean that the housing market has appreciated 100,000 over 3-4 months. Basically what it means is that there's more and more homes in the higher end being listed, because median list price just means that half the homes are listed above that number and half the homes are listed below that number. To get an idea on what price is doing, we can look closer at price per square foot to give us a gauge on that. Back in March, it was $296 per square foot, and now it's $312. You know, we see this decrease in inventories, but we also see this decrease in active days on market, Price decreases are happening less and less. We're still in this, middle market where there's still a lot of uncertainty, and that is actually an opportunity for buyers. So when we're looking at the current market as an opportunity, once we get past the bottom, we're going to see sellers being more confident because there's more competition, less likely to negotiate. But if we catch it before the bottom, well, we've already passed the bottom. It happened in January 2023 this year. We still have some room here to take advantage of fearful sellers, because less competition because of higher rates. And this opportunity is fleeting, but it is still there, and there's still an advantage to having it. So in the last market bottom, we saw 8% appreciation from the market bottom at February of 2012, when there was 2.4 million homes on the market. Over that year to 2013, prices appreciated 8%, and that was with 2.4 million homes. Now there's a little over 1 million homes. Can we expect to see that 8% appreciation again? It certainly is possible and likely, but what do the experts say? The experts are saying that prices have turned higher and the bottom has happened. You can see here, January was the last time we saw negative numbers reported by Case-Shiller, FHFA, CoreLogic, Black Knight, Zillow. Case-Shiller is the gold standard for home price appreciation reports. This includes cash sales and finance properties, and they are projecting a 5% pace after seeing positive month-over-month numbers. FHFA, which doesn't include any cash sales, this is just financed mortgages, so they're projecting 7%. CoreLogic is on the high end, 10%. Black Knight is in line with Case-Shiller, and Zillow at 10% in line with CoreLogic. So prices are turning higher. There's an opportunity for appreciation and a stable housing market moving forward. Low supply is going to support higher and higher home prices. So using the market as an opportunity, if we take a move up situation where someone's purchasing a home at $500,000, they just sold their other home and they're putting $100,000 down, we can do a mortgage of $400,000. Rates are up about 1% from the beginning of the year, so that's an increase in monthly payment of $257 per month, so $3,084 year over year. And let's just say that a seller gives a 2% discount, which is completely realistic. In Maricopa County, 50% of the contracts that are written have at least $9,000 in seller concessions. At least I'm seeing $12,000, $14,000, $15,000, $20,000 in seller concessions that can be used towards buying down an interest rate to lower the monthly payment temporarily or permanently. And if the seller doesn't want to do that, and let's just say that they reduce the price by 2%, that's still $10,000 in appreciation in equity that you've earned right away. So let's say we get some type of discount from the seller, and prices begin to, year over year, will rise 5%, like Case-Shiller suggests it will. On a $500,000 purchase, that's $25,000 in appreciation. So we know that a refinance market is in the future as well. So let's take into consideration the cost to having that higher payment, plus whatever cost there is for a refinance. Take out that $5,000, that leaves us with a $30,000 net benefit in 1 year, just 1 year. This market is not going to last forever. This is the time for people who need down payment assistance, need to use FHA, are using a VA mortgage. This is your opportunity to get into a home before rates come down and all hell breaks loose with prices going up and with limited inventory. And that's likely to be the case. We're likely to see a 2021 type of situation happen again, simply because inventory is so low. There's no signs of inventory increasing significantly to offset the need. So now is the time, unless you want to try and save a bunch of money to compete with people that are selling their houses in other states and moving to Arizona. Now is the time to get into the game, and I want to help you do it. So please give me a call. My number here, call or text me at this number. You can email me at my apmortgage.com address. You can fill out a loan application here at mywayhomeloanaz.com. You can follow me on Facebook or just like and subscribe to this video on YouTube. And I definitely look forward to running any scenarios that you have, seeing what you can qualify for, seeing what the monthly payments will be, and just helping you get through this crazy market in general. So give me a call. Ryan Walmsley, American Pacific Mortgage. I'm here to serve. We'll talk to you soon.